Outside of black swan events that nobody sees coming, markets, for the most part, are completely rigged. In order to not fall victim to these rigged markets, you need to understand exactly how the game is played, and you need to understand the exact script that all the banks run on. This is level 3 understanding the game. Become the observer of the game. So since a black swan event is really the only thing that can catch the banks off guard, it'd be wise to study up on exactly what that is. A black swan event, simply put, is a single improbable event with enormously far-reaching consequences. The longer that you trade, the more and more likely you are to come up against a black swan event. For traders, these are the events that come in and completely demolish your trading model. You might have it all worked out where you think that if I have a certain level of stop loss and I have a certain level of take profit and the market operates within this kind of framework of these normal ups and downs, I'm going to be okay. My system's going to work. And then all of a sudden, you're used to a 20 or 30 or 40 pip range, and one day you got a 300 pip range because something crazy happened. That is typically going to happen with a black swan event. It's going to take you so far past what your normals are or what your strategy normals would be to operate in and completely break the model, causing you typically a ton of losses, usually unrecoverable. Everyone is subject to deal with black swan events. Whether you're a retail trader or you're a bank, we're all concerned. We all need to have contingency plans for worst case scenario situations. That being said, what I'm here to tell you today is that all other price movement outside of a black swan event is running according to the rules of the banks. I want to walk you through a quick example that shows you how a black swan event disrupted the normal buying and selling rules of the banks, but how things quickly returned to normal. Let's take a look at this weekly bar chart on dollar yen. This is from the period of late 2010 coming into early 2011. As we can see, we have an average weekly range of about 145 pips. Yes, we do have some smaller range weeks and we have some larger range weeks, but that is the average. All the traders and the banks that are dealing in this market are used to this typical average range. But let's see what happens. If we scroll forward, we get this massive weekly range here. This is March 11th, 2011, a tsunami hits Japan on this day, causing a 600 pip expansion of the weekly range. This was obviously unplanned. A big, furious move like this can obviously do a lot of damage, especially to retail traders that aren't prepared or think something like this can never happen. Even though we have this big push down, why has it sucked all the way back up into the range? What's wrong with the move is that this is not part of the normal accumulation distribution process of the banks. It was unplanned. Therefore, when it's all over and damage has been done, it's time to return to business as usual. Even though this black swan event may fundamentally change the overall flow of the markets, this was not a big earning move for the banks. They weren't done with their accumulation, getting ready for the distribution phase where they actually make their profit. So what do? They take the market back into the accumulation range and run stops above the high. Normal trading resumes, stop taking goes as planned, and then they let it fall in the overall fundamental direction back into the planned distribution. Regardless of the black swan event and the interruption that that causes, the game must go on. The game will still continue to be played. And as a trader, you being the observer of the game and all aspects of it, now you understand the place the black swan event has, the interruption that it could make, and then you understand when the game gets back on track. You want to play the predictable game, not the unpredictable one. Now that we got that out of the way, it's time to return to our conversation about how the markets might be rigged. Now, when I told people this 10, 12 years ago, it wasn't as widely accepted. No one could think that markets this big could be controlled. That has slowly changed over the last 10 or so years. I've noticed that the conversation has changed in a lot of places, especially in trading circles, to understand and account for market manipulation. And a lot of that conversation is happening due to things like this. We have headlines like this all the time. Former foreign exchange trader sentenced to prison for price fixing and bid rigging. Another one, 6 banks fined $2.6 billion by regulators over Forex failings. Another one, 6 banks pay $5.8 billion, 5 guilty of market rigging. Another one, JP Morgan agrees to pay $100 million to settle a currency manipulation lawsuit. Investors accuse 12 major banks of rigging prices in the $5 trillion a day foreign exchange. Huge market, yet rigging exists. If you've been watching this whole series, you'll notice that there's level 1, level 2, and level 3 understanding. This is on level 3 understanding for a reason. I have tried to share these concepts with newer traders, ones that would be looking at the basics of our methodology on level 1. And when I tell them that the markets are completely 100% rigged, they have a hard time getting their head around it. How can something so big that's supposed to be fair, supposed to be regulated, how could they be rigged? Well, they are, because there's no end to the greed of this world. And that's just how things go around. So part of becoming a good trader is fully accepting that these are our realities and understanding how these things happen and preparing for them so that you aren't a victim of it. This becomes a major part of your overall trading strategy and your approach to the market, because you understand that it is a reality, that rigging and manipulation is happening constantly, and the only way that you can battle against it is to understand it and play along the same rules of how those markets are manipulated. Why the markets may be rigged. I got a bunch of bullet points. I'm just going to blow through them to drive my point home. Forex, in particularly, is the lifeblood of the world. It is a circulation of money between countries. Over $6.6 trillion are traded daily in Forex. Banks will do almost anything to increase profitability. I think we've established that already. Forex is one of the least regulated markets because it is so big. You can get away with a lot. So a lot of rigging, a lot of manipulation exists. If you can get away with making hundreds of billions in profit, you don't mind a few billion in fines for the occasional slap on the wrist. A few $100 million up to a few billion in fines is simply the cost of doing business at this level. No problem. So why is it important to understand markets may be rigged? Well, when you look at the markets from this perspective, you better anticipate behavior and moves no one else thinks can happen. It's all about positioning yourself beforehand. When you expect manipulation, you look for it, you lie in wait, and then you can act, and then you trade in line with the banks. Whereas the unsuspecting crowd is surprised because they think it can never happen. That becomes part of your strategy. Manipulation becomes the leading indicator. We can't talk about all that without also addressing the effects of normal plan news. That also does move the market. We've all seen it. But what I'm here to tell you is that that news doesn't change the game. It simply speeds it up. Now, what again is the game? That's the 3 market phases. It's the contraction, the expansion, and the trend. That is the master pattern. So regular plan news just speeds up that pattern. Let's look at an example. Right here we have the sideways market coming out of contraction. We see that the news release hits and we see the market spike up, okay? We've all seen it a million times. This is very common, okay? As the market goes further, we have another news release, market spikes down. What is happening here behind the scenes? What's the framework? It's just the master pattern multi-leg expansion. This was going to happen anyway. The news just made it happen faster. And that's all I can tell you about normal news. It's going to come out, but it's going to typically aid in the accumulation and distribution process that the banks have already planned for, just to make it all go faster for them. Now, I'm not here to have a debate or push out any conspiracy theories surrounding COVID-19 or how it was handled, but what I do want to show you is how it looked in price action on euro dollar. I want to see, does this look like something that was planned price action running the normal script from the banks, or was this a black swan event like the tsunami? Let's take a look. Looking at this chart of euro dollar, let's see what we see here. Do we see the 3 market phases playing out? Well, this is of course running on our software ATS. It's designed to look for the 3 market phases. So I want to start with that green box where the number 1 is. We have the market maker set up the contraction phase. That is that first phase of the 3 market phases. So I can clearly see that. Now, as the market progressed, let's see where COVID-19 hit the mainstream news. That was right about here. News hits and a classic multi-leg expansion ensues. So what is that? A multi-leg expansion is when the market swings high, swings low, swings high, swings low, and starts widening out. We can see that in the red kind of sideways triangle. So what happened here? We could see that the market ran all the way up where that little number 4 is. We could see that it looked like it was taken off in a very predominant uptrend after it went down. But what happened? It immediately reversed and went all the way down to this low here. This looks like a massive liquidity grab. It looks like the market wanted to go up, but it wasn't ready for some reason. So the market was driven down. Potential I'm not saying it did happen, but could have been a lot of stop losses down at that level. I don't know. And then, sure enough, it went sideways and then went back in that direction. This here looks like a classic master pattern, a classic multi-leg expansion. COVID-19 certainly got things whipping around into that whipsaw action. But if we look at the dynamics behind that, I think there was a potential for a bank to make a whole lot of money playing this move. As I said before, manipulation is the new leading indicator. The manipulation in the market has gotten so prevalent, so bad, that it has now become a strategy. In fact, you don't want to do anything until you clearly see the manipulation and understand it. So let's look at the same market move, but from two different perspectives. So the first perspective we're going to look at is the normal retail trader perspective. This is what all retail traders are taught. They see a clear uptrend forming. They're going to put their trend line there. Should I put it at the wick? Should I put it at the body? Whatever, pick one. But either way, there's an uptrend forming and then it breaks through that trend line. Traders either close their buy positions or they think this is a sale opportunity, they jump in. But what happens? Market comes right back around, whips right back up through that trend line that we thought was going to be the perfect trend line to hold price. And it crosses back, traders jump back in, suffer losses, they don't know what's going on. But what really happened in this move? What happened behind the scenes? What are the actual dynamics according to the bank's business model? Where was the manipulation? Now the same move from the market maker's perspective. Let's see how this plays out. What do we want to look for first? We want to look for contraction. That's that balancing point in the market. That's where it all starts from. So we see the contraction box right there. We see the value from that contraction box painting forward. What happens? Well, we see that bounce. We can see that traders are lured into a long position. They think it's taking off. But what hasn't happened sufficiently yet? Manipulation. We want to see how are the banks accumulating. We're looking for that leading indicator so that we can act. So what happens? Very predictably, the market runs down through their pain threshold. Certain liquidity is down at that level, and the banks will almost certainly go get that liquidity, and that's what we're waiting for. There goes the manipulation. Stops are purposely harvested for liquidity. This is what you're looking for. And then the market takes off. Price gaps aggressively back through value, showing the market maker's true intent. And then the market enters the distribution phase as they take their profits from collecting those stops earlier. This is the game. This is how it goes round and round. You need to be observing this game. You need to be looking for the manipulation as your leading indicator. No manipulation, no trading, because the manipulation is what reveals the story to us. To really advance as a trader, you need to work on distancing yourself from the players of the market. You want to look above everybody. There's retail buyers, there's retail sellers, there's institutional buyers, there's institutional sellers, there's market makers, there's all this stuff happening. You need to understand the game at the highest level so that you can sit above it all and figure out what the real story is. You want to become the observer that's looking from all perspectives, taking all things into consideration to figure out what is the real deal. Now, rising above all the noise and trading from a completely neutral place is really difficult to do. So I've come up with some questions that you can ask yourself that'll keep you in the right state of mind and focusing on the right thing. Question number one, where are the market makers positioned? Where are the balancing points in the market? Because we know that they manage their positive and negative selection portfolios around points of value or balance in the market. We definitely want to map those points out because those are the tipping points between the beliefs of buying and selling on the part of the masses. Question number two, where is the higher time frame flow of money headed? Ultimately, if the weekly and the monthly charts are aimed up, that's pretty significant. That's where the banks are likely driving price. So we definitely want to know where that's headed. Question number 3 and 4 kind of go together. Who's likely to lose and how will they lose? Well, taking question 1 and 2 into consideration, where are the market makers positioned? Where's the higher time frame flow of money? Helps us answer question 3 and 4. In this situation, we have a downtrend. We know that everyone that trades above fair market value is going to typically be in a weak position. They are going to be likely to lose. So by taking a bird's eye view, answering these questions, we know exactly who we want to trade with. We want to look for manipulation to the long side to be able to take the other side of those buyers coming into the market doing exactly what the banks do, exactly what the market makers do. That way we're trading safe. But we want to look for that manipulation as that leading indicator. So when you answer all these questions clearly, you will also have your trading plan. So what's the takeaway of this lesson? Other than Black Swan events, news is fuel for the market maker's business. News simply speeds up predetermined price delivery. It is not random. Your edge is in taking a bird's eye view of all players in the market and then joining in with the side that is likely to win. And markets are definitely rigged.